Well, good morning and welcome to this fortnight's webinar. Thank you all for joining us. Today's topic is traps in trustee resolutions. This is a topic I actually really enjoy working in, although it's quite a niche area. I enjoy it, I think, because unfortunately I see a lot of trustee resolutions that are probably insufficient is probably the best way to describe it, and don't really take account of many of, I guess, the nuances of trust law and also particularly the streaming rules. So I enjoy educating accountants and other people on this topic to help them get their resolutions to a better standard. For most clients, though, it is, as I said, quite a niche area that really doesn't impact them in their everyday life. But unfortunately, sometimes for some clients, it comes up all too late once a resolution is done and perhaps doesn't have streaming done properly. It can be a disastrous outcome for them. We're going to hear from Adrian Bailey, who's going to talk to us on this topic today. I thought I'd flag at the beginning a couple of upcoming webinars we've got in 2 weeks' time on the 8th of October. Adrian is going to give another paper on the title is Do Testamentary Trusts Work? And it'll be an expose of what a testamentary trust is about, likely some tax features of them and how they should operate in practice. Following that, a fortnight later on the 22nd of October, we've got a slightly different webinar. It'll be what we're calling Ask the Experts, a roundtable with myself, Adrian, and our fellow principal, Brett Hart. And it'll be the three of us on the screen, answering and having a discussion about any questions you might have. In our email out for that, we'll ask you to put to us some of your questions. And we'd like, obviously, some of those questions earlier in the piece, but if you raise your question on the day, we'll probably likely get to it. So hopefully that'll be an informative and not too scary for us. But we're looking forward to that. So today we're going to have a few polls. We're going to start with one which was forced upon us by Adrian's family and the Sydney office, whether Adrian should have his beard shaved off. So if you can have a look at the polls section on your screen, you'll see them come through. People are starting to put in their answers. The moment you're looking all right, Adrian. Anyway, a bit of fun to start off the day. We'll have a few more polls through the session. Obviously, everyone has worked out how to use them. If you've got any questions, punch them in the chat and I'll ask them of Adrian through the paper. Final thing, there is a few files to download. Obviously, the presentation is available for you in PDF format. We've also got just an example minutes for trust streaming. And Adrian will get to, I guess, some explanation of that, but that's a little document that we use internally to help our lawyers, myself included, draft good and effective trust streaming resolutions and resolutions for trusts. So I'm going to hand over to Adrian, and if you've got any questions, shoot them through on the chat.
Thanks, Paul. If I'd known you enjoy this topic so much, I probably would have imposed on you to present. But nevertheless, as mentioned today, we're going to be talking about some traps in trustee resolutions. A large part of the paper will focus on tax issues. So having a look at the concepts of income in the legal sense, net income and distributable income, and having a look at streaming. And it tends to be where we see the most issues with resolutions. And certainly when you look at the cases that go through in terms of tax matters, generally speaking, it's in relation to whether the distribution was done right for tax purposes. But that's not the only way that resolutions can be impacted in terms of their effectiveness or not. So we're going to touch on some points in terms of the timing of the resolutions and when to make them. Issues other than tax, so having a look at other and particularly some case law in relation to considering beneficiaries and whether we should be documenting that consideration or what sort of things we need to take into account if we're making distributions as the trustee. As I said, non-tax reasons. And then running through how to draft an effective resolution from a lawyer's sense, recognising that obviously as lawyers we like to document things fairly comprehensively, but just to run through that, and obviously with that example that Paul recommended. So jumping into the tax part first, we do need to revisit the legislation, which of course main parts in terms of taxation of trusts is contained in Division 6 of the Income Tax Act 1936. And I guess the first thing is that generally speaking, the trustee is not generally liable. I use generally twice in that sentence, I just recognised. But what that means is that unless otherwise provided, a trustee is not liable to pay income tax upon the income of the trust estate under Section 96. Of course, there are lots of provisions that can make the trustee liable, but it's reinforcing the concept in terms of the treatment of taxation of trusts, that they are meant to be a flow-through vehicle. And so with that, that flow-through aspect, clearly we need to set some ground rules within the legislation as to who ends up paying that tax. And to that, of course, we need to turn to Section 97 and the concept of a presently entitled beneficiary. And so the red highlighting that you can see on the screen, they're aspects that we're going to examine a bit closer. But what Section 97 says is that where a beneficiary of a trust estate who is not under any legal disability is presently entitled to a share of the income of the trust estate, the assessable income of the beneficiary shall include so much of that share of the net income of the trust estate as is attributable to a period when the beneficiary was a resident. Long-winded way of saying that when you are a beneficiary of a trust estate and you've received income from it, you're liable for that income in terms of taxation liability. So we're going to run through each of those highlighted sections because they are all areas that have been examined by the courts, because they are, in terms of the wording, it's been really closely examined for a variety of reasons over the years. And each of those underlying parts have been examined in specific cases. So the concept of presently entitled, how do you become presently entitled? It's not defined within any of the tax acts. So we take the definition from interpretation of the court, and probably the one that's most quoted is the Harmer's case there, that says that a beneficiary has an interest in the income, which is both vested in interest and vested in possession, and they have a present legal right to demand and receive payment. So we have those elements, we are presently entitled. So we've got an interest in the income, and that we have the ability to demand and receive payment of the income. We're therefore presently entitled to that income. There are some areas where we can be deemed to be presently entitled, and some of the circumstances there where you can think of that, and this is not what this section is covering, but another example would be where we have a child who legally can't call for the income. So there are some deeming provisions there that deem them to be presently entitled. But we have here Section 101, an example. So a beneficiary in whose favour the trustee exercises the trustee discretion shall be deemed to be presently entitled to the amount paid to the beneficiary or applied for the beneficiary's benefit. So to take into account the example where we may have advancements of cash as well as a distribution, if we're receiving the cash, we're deemed to be presently entitled to that amount, or to the entire amount. Section 95A, and there's two subsections we'll work through, is another area where you have what you consider to be a deeming of present entitlement. And generally speaking, 95A is what you consider an anti-avoidance, or a section that compels the flow-through aspect of taxation of trusts. So 95A1 says where a beneficiary is presently entitled to any income of the trust estate, the beneficiary continues to be presently entitled regardless of whether the amount is paid or applied for the beneficiary. So classic example, would that be I distribute from my trust $100 to myself, but at the end of the year, but I don't actually cash flow the amount. I'm still deemed to be presently entitled, regardless of whether the amount has been paid or not. The second subsection of 95A2 says that where we have a vested and indefeasible interest in any of the income of the trust estate, but not presently entitled, the beneficiary shall be deemed to be presently entitled to that income of the trust estate. So where that may be an example of that sort of example, two that I can think of. If the trustee is advancing us cash, but not making any distributions, and that cash is related to income, we could be presently entitled under that. Or where we have default beneficiaries, and for example, no resolution is made. We've got a vested and indefeasible interest because of the default provisions, even though we weren't made presently entitled by the trustee. The next section that we have to work through in 97, or sorry, the next part of section 97 that we have to have a look at is income of the trust estate. There's been a series of cases over the years in terms of what that means. But again, it's not defined. I guess at the end of the long series run of cases ending up in Bamford's, we've got the accepted definition that income of the trust estate is given its ordinary meaning by the general law of trusts and the trust deed. So with that, income of the trust estate depends on what our trust deed says the income is. So that's one of the reasons why it's important, obviously, to be aware of how our trust deed defines income, because that's how we get that part income of the trust estate from section 97. Another example of a more recent definition is Tolledge's case, which says it's the net amount after subtracting all expenses on revenue account from income on revenue account. A bit more of an economic or accounting definition, I'd call that one. Distributable income. So the concept of that is that a beneficiary can only be presently entitled to income which is legally, which means according to trust law, not tax law, available for distribution of the beneficiary. So we've certainly adopted that concept of distributable income in our trust deeds to define income under the trust law. And the reason for that is to try to avoid those mismatches where we have a difference between income for trust law and income for tax law. If our trust deed is talking about distributable income, then that can only ever be the income that we can distribute under the trust deed. One of the areas that you may come across, and every now and again you get a query in relation to this, is what if we actually don't, under trust law, have any distributable income? What if our expenses on revenue account exceed income on revenue account? And we've got income for tax purposes, but we don't have income for distributable income. What can we do there? That second dot point, there's a typo. That should be income reclassification clause assist. So that's the sort of clause where it says that we can treat capital as income and vice versa. So I guess the short answer could be we could have the potential, if we've got those powers, to treat the amount as an accretion to the trust fund and distribute it in accordance with those powers. However, we do need to be aware of colonial first state investments, which was a case that involved reclassifying things as income or capital, or the attempt to, by colonial first state. And in that, it was found that because the constitution of the trust deed in that circumstance, it was a managed investment trust, didn't allow you to reclassify income as capital and vice versa, then those resolutions were ineffective. So coming back again to that golden rule of making sure we have the power to, and it's within the deed. The other aspect of section 97, which has been examined multiple times over the years in cases, is this idea of so much of that share. So I'm presently entitled to an income of the trust estate of so much of that share. And that's how I'm assessed. So in terms of section 97, it sets out that a beneficiary is assessed on the same share of taxable income as a distributable income. And then of course, the question then arises, well, what if there's a change down the track? And generally that change arises because there's a reassessment of a tax return, or something's disallowed in terms of deduction. Do we then apply the quantum view or the proportionate view? And the difference between the two, the quantum view would be, for example, I give $100 to Adrian and the balance to Adrian's company. The quantum view would say $100 is all Adrian ever gets. Even if it's reassessed later, the balance will go to Adrian's company. The proportionate view says that we look at it in effect from a fractional method, and we look at $100 versus what to the company got, and then whatever is changed in terms of the assessment, we get it in proportion to whatever those percentages are. And that was found to be the most suitable analysis of so much of that share. And again, we had a series of cases culminating in Bamford where the High Court took that view. Net income. So Section 95 actually defines net income of the trust estate. So we've got the definition there. I won't read it in its entirety, but it's the total income as if the trustee were a taxpayer and were a resident, less all allowable deductions, except some exclusions. So in essence, we're looking to get to net income. We look at income less expenses, and we treat the trustee as if they were the taxpayer. And that's how we reach net income under Section 95. I mentioned before that in terms of just the amount that we can actually distribute and net income, there can be differences. So that does happen. Generally speaking, it's because an amount is not deductible for tax purposes, but it is under the trust law, or there's a timing difference there, and depreciation and employee entitlements are one of those. So it can get a little bit messy, and that's quite often what we see people struggling with in terms of the differences between the two. In terms of variation of income clauses, and what we mean by that is trying to address Bamford's case, where the proportionate view was adopted. Is there a way of, in effect, getting around that? And I guess the short answer is, if we have a look at Lusky's case, we had that sort of situation where the resolution said that if the Commissioner of Tax disallows a deduction or includes more assessable income, there is a distribution to a particular beneficiary. And Lusky that was found to be effective. You're always going to have lawyers arguing over this as to whether that's an effective resolution or not. We can rely on Lusky to extent that it is. Of course, we need to make sure that our trust deed has that power and allows it, but it could be an option there for clients, just as a bit of a safeguard there. And I think probably internally our view would be, well, it's probably better to have it in there than not. In that's at least one more argument we could raise if there is some sort of major change down the track in terms of disallowing a deduction or including more assessable income. Moving on to streaming, and legislation was introduced some years ago. That gave to deal with streaming of capital gains and franked dividends. It was decided that they need to be simplified to some extent. So of course they weren't when the legislation was introduced. But what was clear within the legislation that it doesn't give the power as a trustee to stream where they do not have power in the deed. It's generally not going to be an issue with any deeds that you have for clients that are produced from, say, around the 90s onwards. Most of those deeds will have the power to stream different sorts of income in there. However, older deeds can certainly be an issue there, and deeds from what you'd call unusual sources. So most of you would probably be getting your deeds from one provider, and generally speaking, they're much the same and they cover much the same sort of areas, and they'll almost certainly have streaming provisions in them. But if we have a deed drawn up by a suburban lawyer or a suburban accountant, then, and it's an older deed, as I said, then we certainly want to make sure that we have a look at it to make sure that it gives the trustee the power to stream different types of income. Because if it doesn't, then we can't stream under the legislation. So the actual legislation that deals with it is subdivision 115C, so that's for streaming capital gains and franked dividends. So that's for subdivision 207. They're both reasonably similar. There are some differences between the two, but we'll run through some of the key terms within the legislation. So we've already discussed how to be presently entitled. With this, have our streaming resolution effective, we need to be specifically entitled, and that is defined within the legislation. And we also need to receive or reasonably be expected to receive the net financial benefit, and we'll run through what that means. Remembering, if we're using these provisions, it's because we want to send capital gains to a particular beneficiary. And generally speaking, that's so we can access the discount gain or small business concessions, or we want to send franked dividends to a particular beneficiary. And generally speaking, that's because we want to send them to a company, for example, and we want to send other income elsewhere. We don't need to worry about these provisions if we're not streaming. So if we're not sending those sorts of income to different beneficiaries. So it's not always going to be relevant. Where you certainly find it the most relevant is where we're having a large capital gain and we're using the small business concessions. We want to make sure that we're following these rules because otherwise we could have some reasonably catastrophic circumstances from a tax perspective. Specifically, a title, as I said, it is defined within the legislation. It's got two requirements, in that a beneficiary must receive or reasonably be expected to receive an amount equal to the net financial benefit, referable to the capital gain or frank distribution, and it must be recorded in its character as such in the accounts or records of the trust. Second one's relatively straightforward, but the first one, there's a few different things in there to examine to see how we get there. We are we said to have received or reasonably be expected to receive if we receive an amount equal to the share of the net financial benefit. So if our capital gain is $100, we receive an equivalent amount of $100 as a net financial benefit. Now, it doesn't mean that we have to show that $100 flowing through, that exact $100 flowing through the trust accounts. So that's what we mean when we say it doesn't require an equitable tracing. And it can be expressed as a formula, even though a result of the formula is calculated later. But in essence, we need to show that our beneficiary who we want to receive that capital gain receives the financial benefit of that amount. When does this occur? Well, we receive something when it is credited, distributed, or paid or applied on our behalf, or will reasonably be expected to receive when we've got present entitlement, it's set aside exclusively, we've got a vested indefeasible interest. So that second part is the scenario where, and we've covered it on the slide, where we have a contract signed 1 year and settles the next. We should be making our distribution for capital gains tax purposes in that year that it's signed as opposed to the next, but clearly we don't have the money. So in order to cover that scenario, that's the reasonably be expected to receive. Net financial benefit is also defined. It's the actual proceeds of the trust reduced by losses or expenses. So an example here that we've got on the slide, a trust sells an asset for a gain of $1 million. It's got a previous capital loss of 500, which applies against the gain. So the net financial benefit is 500,000. So in that circumstance, we need to give Peter, who we've got named here on the slide, a net financial benefit of 500,000 to make sure that we can stream to him. If we didn't have any losses, of course, we would have to give him the entire $1 million net financial benefit. The second part of that specific entitlement is it's referable to the capital gain or frank distribution. So for that, there are different definitions. Capital gain is trust proceeds reduced by losses, which we've just been through. Frank distribution is amount of the frank distribution reduced by directly relevant expenses. What they mean by directly relevant expenses, to use an example, I have a trust and I borrow $100,000 to buy $100,000 worth of listed shares. That interest paid is a directly relevant expense, which comes off the frank distribution. Remembering, we should remember or be aware of that there is an exception to the streaming legislation and that it doesn't apply to gains involving the market value substitution rule. So we can't stream those gains. So it's an important thing to remember if we're doing internal restructures. We may want to make sure that we're paying consideration so that we don't, even if it's by check or note, so that we don't have situations where we have a market value substitution rule that we can't stream. Another requirement of the streaming rules, the second part, which I said was relatively straightforward, is that it's recorded in its character as referable to the capital gain. So that's what we do in terms of our resolution or our distribution statement. We make sure we record that that amount is in relation to that capital gain or that frank distribution. Just doing it in the tax return only isn't sufficient. We do need to have that contained within our resolution. So an example, the trustee sold a property at Smith Street, resulting in a capital gain of $100. It resolves to separately record and characterise that income in the books of the trust. And that was paraphrasing what we'll be talking through later. For streaming, the timing of the resolutions. So for that, it's a little bit strange in my mind. We've got two different timing periods. For dividends, it's the end of the income year. And for capital gains, it's within 2 months of the end of the income year. The rationale or the stated rationale behind the capital gains extension is that sort of gives you time to calculate it. And also for that scenario where we have a sale in like the month before in terms of the contract, and it's settling the month after. In reality, I think if a push comes to shove, it comes back to what the deed says. If the deed says we have to resolve to distribute our income by a certain date, and pretty much all of them do, then we are going to need to distribute by that. And I don't think it's really relevant anyway in terms of capital gains, because as I mentioned before, we've got that reasonably expected to receive carve out, and we can do it by way of a formula or by an amount. So I don't really see the necessity to have that extension, but it is there. Again, if we find ourselves in the position where we have to rely on it, at least perhaps we could rely on that if there's a significant dispute with the tax office.
Adrian, I've got a question come through.
Yep.
So Trust prepared a distribution statement to issue 100,000 net income to a beneficiary who's an individual. Does the amount need to be physically distributed through a bank transfer from the trust bank account to the beneficiary's account?
No, it doesn't.
Okay, that's it. Nice and easy.
Yeah, I'm not like you, Paul. I don't then go on and explain the answer.
I would have talked for 10 minutes.
What happens if you get it wrong? So what if we don't make somebody specifically entitled or only partially specifically entitled? We then have our capital gain. It does still flow through proportionally, but not in accordance with our share of trust income. It flows through in accordance with this idea of this adjusted division 6 percentage, which of course is a formula-based approach. And what we tend to look at is, and we're looking only really specifically at capital gains and franked dividends. So we're looking at the present entitlement, excluding any capital gains or franked dividends to which they are specifically entitled, against income of the trust estate, excluding any capital gains to which any entity is specifically entitled. That will give us a percentage, and then we apply that percentage to the amount of capital gain or franked dividend that we have not made specifically entitled to. If we get it wrong, the reality is very likely we will end up with a capital gain in somewhere where we did not want it, or a dividend somewhere where we did not want it, or part of it anyway. So it is important that we work through those provisions if we're looking at streaming capital gains or franked dividends. We did have, I won't run through it, but we've got what we call the Cleary-Hall Trust streaming flowchart. But it's just a ready reckoner to go through how we would need to look at our steps and make sure that we're getting to the right position at the end of the day. That's the end of what you'd call, I guess, the pure tax part. Paul, I'm curious to know whether I'm still keeping this beard or whether it's gone.
So I'm not sure the answers to the poll really have any influence. I think your family may have a greater influence, but no way. Keep it shaggy wins the day on 43%. Fairly evenly split. 25% maybe just a trim. 31% get that thing off.
Well, I can say that my wife and my daughters are firmly in the get that thing off. So, yeah, thank you for your answers. But the unbearable pressure I've been under for the last couple of months of shaving will continue, no doubt. So perhaps next time you see me, I'll be clean shaven.
So I guess, Adrian, looking at the next, we did run another poll in relation to whether or not they use trustee template resolutions. Mm-hmm. Yes, 71%, so fairly significant proportion. No, 7%, and only for simple matters, 21%.
Yeah, okay. Well, that's pretty consistent with what we come across anyway. Next point we're going to cover is timing of resolutions. So, and reason that we talk about this really is because quite often it's the white elephant in the room, isn't it? In that, I know what happens on 29 and 30 June each year, and I doubt whether it's a succession of clients through your office sitting in your boardroom signing their trustee resolutions. And that's for a variety of reasons. But with that, the timing of the resolutions, what does the law actually say? And aside from some of the provisions of the Tax Act which can operate, we can look at Colonial First State Investments again, which says that a beneficiary can only be presently entitled to income which the trustee has appointed in the beneficiary's favour prior to the year end. So we do need to make our resolutions from a tax perspective before the end of the year. And also in terms of our deeds, some of our deeds will certainly, well, pretty much all of them will have provisions that or clauses that require you to make it by a certain date, otherwise something else happens. And that may not always be the end of the year. That may be a couple of days before. So again, it depends on who drafted the deed and why it's one of the reasons it's important we read it. One of the questions, and I know it's a poll question as well, which is when do you do your client's resolutions? Do you do them before the end of the year? Do you do them always on a particular day? Do you do them tax planning when they come in May? Do you do them afterwards when you're doing your accounts? And it is an area you can kind of get caught up on and go down the rabbit hole in terms of when you should do it, when you shouldn't do it. Clearly, from a legal perspective and trust law perspective, they should be done before the end of the year. I recognise that's not always practical. As a mentor used to say to me, it's only a record of a resolution. You can always say that the resolution was made but not documented. We want to go down that road. But I guess probably more just a bit of a cautionary story. Have been involved in a client matter where the accountant was required to attend the tax office for a compulsory interview under Section 353. And through that, they went through about 15 years of resolutions that they had on file because the client had been under audit for some time. In classic, it was a barrister leading the examination. In classic barrister style, they ran through everything where they said, oh, you see this resolution from 2010? Yep. What's the date on it? 18th June 2010. This resolution 18th June 2011. Every single resolution was dated 18 June. And at the end of, after we'd run through those, the barrister then asked, what sort of hours do you work in a week? 50. What sort of days do you work? Monday to Friday only. And then, of course, lent to and pointed to some of the years where the 18th of June was on a Saturday or a Sunday. So clearly the resolution was not made on that day. And the accountant had put themselves into a position where they had now, under oath, because 353 notices under oath, had perhaps not told the whole truth. So just a cautionary tale there. There is no perfect answer, of course, and we've all got to be pragmatic about it. But you certainly probably should be building in some systems where you at least talk to the clients about the resolutions beforehand. And I'll mention this in another case that we're going to talk about on a non-tax matter, but certainly something you should look to implement just to protect yourself and not fall, I guess, victim to the client pressure of then saying something that may not be true down the track. Issues other than tax, which is the other aspect that I said we were going to cover today. So, and this is talking about what rights really the beneficiaries have and how much consideration the trustee should give to the beneficiaries when we're making our distributions of income or distributions of capital when we're making our decisions. So very common, well-worn thing for a lawyer, particularly one that works in trust, to say is that the rights of a beneficiary of a typical discretionary trust amount only to a right to be considered by the trustee. And generally speaking, we're saying those sorts of statements because there's some sort of fight where a beneficiary is getting sued and someone's trying to access the trust assets because they're a beneficiary, going through a family law dispute, slightly different scenario there, or they're going bankrupt and the trust in bankruptcy is trying to get access to the trust assets. So the case of Gartside, which is a United Kingdom case, but is the law in Australia, provides us with that statement. I guess then the question could arise, well, how much detail should we put in our resolutions about what we're thinking about in terms of the beneficiary? Now, it will depend on the circumstances, and it is a bit of a double-edged sword, because we've got the case of Karger and Paul, which says that unless trustees choose to give reasons for the exercise of discretion, their exercise of discretion, that should be cannot rather than canoe, be examined or reviewed by a court as long as they act in good faith, two typing errors, without an ulterior purpose. So if we record why, or we record our reasons why we exercise that discretion, it can be reviewed by the court. If we don't, but still, if we're acting in good faith and without an ulterior purpose, we can still record them. So as I mentioned, it will depend on the circumstances, but in some circumstances, you'd probably definitely want to record those reasons, and I'll run through the reasons why. And two examples why, and both of these are involving superannuation. So first, Finch and Telstra Super, where it's decided if the consideration is not properly informed, it's not genuine. So we would want to have in that circumstance evidence of the trustees being properly informed before they make their decision. And another one, Marcella and Wareham, which you would have seen us present on before if you've been to some of these presentations before, which is another, well, it was two. There was an estate dispute and a superannuation matter. This is from the superannuation matter. That a failure to exercise discretion, that it's failure to exercise discretion unless it's with real and genuine consideration. So we need to be genuinely considering the beneficiaries. And that was, as I said, slightly different circumstances in terms of involving superannuation. But it shows that in some areas we will want to show that we have had genuine consideration of the beneficiaries to make sure that we're not falling afoul. And by falling afoul, what the end result is that the resolution or the distribution would be ineffective. And in some circumstances, that's going to lead to some other consequences. Which brings us to Owi's Family Trust, which is a Victorian case. Sorry, I just got distracted. I was thinking Owies because my 18-month-old says Owie all the time. Generally speaking, it's not because she's hurt, but because she's frustrated. But there was certainly some hurt in this case. So we had parents, John and Eva Owie, and they established a family trust. And they were the parents of Paul, Deborah, and Michael. It had a trustee company, had a company acting as trustee for its entire period. John and Eva were directors of that, and at certain stages, Paul and Michael were also directors, even though it's clear in the case that they didn't actually know they were directors until they were sacked as directors. But they were also directors of the trustee company at certain times. Under the terms of the trust deed, Paul, Deborah, and Michael were the primary beneficiaries and the takers in default. So by takers in default, what I mean is that if the trustee didn't make a distribution, they would share in the distribution of the income equally. And similarly, if the trust was wound up. John and Eva were general beneficiaries as well. So they were beneficiaries, but Paul, Deborah, and Michael were defined as the primary beneficiaries. So probably not too dissimilar to what you would see in a lot of client structures. Paul and Deborah were estranged from the rest of the family. In terms of that, it ebbed and flowed. Sometimes, as you often see, perhaps in your own family, sometimes you're in the good books, sometimes you're in the bad. But Paul had come in and out of the family life, so to speak, and had lived away from them, had no contact with them for a number of years, had come back. And Deborah, much the same by her choice, for a series of years had no contact with them, even though her parents, via the trust, did provide her with a property to live in. So with that, over the years, and the years examined went from 2010 to 2019, distributions were made by the trustee to John, Eva, and Michael using a pretty much pro forma resolution. I mentioned before, the concept of calling the clients first, and this was brought up in evidence from the accountant who acted for the Owie Family Trust, in that every year he would call Eva, she was the one that did the books, and say, it's coming up to year end, you need to start thinking about making a resolution and where it's going to go. And that was their practice, to make that call beforehand so that they knew that directors of the trustee were then talking about it and perhaps making a resolution, even if it wasn't written. John and Eva passed away before the court matter was finalised. Eva passed away after proceedings had commenced, and John passed away, I think it was a couple of weeks before proceedings commenced. So he had actually provided a statement which was admitted in evidence. Eva hadn't. So the court proceedings were Paul and Deborah challenging the distributions and saying that they were invalid. So from 2010 to 2019. Now, why would they want to do that? Well, the reality is if they were successful and the resolutions were invalid, then the trustee wouldn't have made them. They were default beneficiaries along with Michael. They would each receive a third of the distribution, so Paul and Deborah, so 2/3 of it. And of course, the trust had fairly significant assets. It had about $23 million in assets. And in 1 year, for example, the income distributed was $1 million. So it would have been a fairly substantial windfall for Paul and Deborah because then they would have been entitled to that amount. And then they would have been able to call for those amounts. In terms of that argument, there were some other aspects of this case which were examined in terms of variations to the trust to add and remove people as in various roles. I'm not going to talk about that one today, that part of it today. But what we're focusing on was the trust resolution effective? So there were a couple of aspects to this. What the court did find in terms of the earlier resolutions was that going back to review them now was now statute barred. So there were a number of years that were automatically kicked out from that, I think from 2010 to 2013. So we didn't need to, they weren't further examined. The court didn't further examine them. But in the years since then, it did depend, and the court did look at each year, and it depended on whether what knowledge that the trustees had or the trustee company had of the circumstances of the beneficiaries. So in that perspective, the argument of Paul and Deborah was, hey, we had significant financial need in some of those years. Deborah in particular, as she had some medical issues. And there was no real and genuine consideration by the trustees. The trustees tried to raise an argument to say, well, I'm paraphrasing here, hey, we're all family. We kind of knew, even though we weren't in contact, what was going on, so we were considering them. But what the court didn't accept that argument of the trustee. The other argument raised by Paul and Deborah was that they'd acted so badly as trustee, they should be removed and somebody else appointed. So there were some years where the court found that there was no real and genuine consideration, but that tended to be because they had no evidence to show they had received information. So what I mean by that is there were some years where for example, Paul was completely out of touch with them, so they had no idea what he was doing. So they had no evidence to give him proper consideration as to his circumstances. So the trustee couldn't consider whether they should give him anything because they simply didn't know what he was doing. So those years, even though there was no real and genuine consideration of him, it didn't matter. In the other years, in terms of some of them, it was found that coincidentally or conveniently for the trustee, more luck than good management, they either did know the circumstances and they gave consideration, or in Deborah's case, because they had been providing her with trust property, they'd clearly given her consideration and she didn't and there was no, not necessary to consider whether the result was grotesquely unreasonable, which seems to be the new high bar. So a lot of dirty linen aired in that judgment. If you ever go and read it, you'll see all sorts of statements in there. Certainly the parents didn't seem like the warmest of parents in some of the things that they did with the children, but can show the sort of fight that we can get into and some of the things that we may need to consider. I guess the lessons from ours, beware default deeds. Cleary Hall have not used default deeds for some 25 years. And the reason for that is clear, that we can, if we have an issue, have income or other aspects going to people that necessarily we don't want it to go to. Whereas if we don't have a default provision there, then it will be assessed to the trustee, recognising we will pay more tax, but that may be a better outcome than in this case, if Paul and Deborah had been successful, having to give them 2/3 of the trust. We may also need to consider the family dynamics and do we need to document consideration? So bearing in mind that there may be some circumstances that we do need to do that. And we probably also need to be aware of what I've called their strange deeds. So deeds where we might not only have a couple of beneficiaries, for example, and that's not out of the realms of possibility. You certainly see some deeds where there might be only 3 or 4 beneficiaries. In those sorts of deeds, I certainly think that we'd need to document that we've given the beneficiaries some consideration. In the normal scheme of things, if we've got a fully discretionary trust or even a default trust where we've got a wide range of beneficiaries, no particular strange family dynamics, in short, we don't have to worry about these sorts of things, I wouldn't think. But it is something to be aware of and something that if it does pop up when you're talking to clients, maybe to get some further thought on or get some further advice on it for them. All right, moving on to the next section, which we're talking about.
Sorry, Adrian, I might just jump in with one question. It's a follow-on from that earlier question about cash flowing or not. So in relation to that, obviously for tax purposes, there's no need to distribute the money. However, the beneficiary is a wife of the trustee. Due to family issues, they're separated. Can the wife be able to establish in family court to receive all unpaid amounts shown as distributions in the financial statements?
Yeah, yes. So even if it's unpaid, the distribution is an asset of the beneficiary. So if that beneficiary is the wife, clearly she can call it up. If that beneficiary is the husband, it may be part of the marital pool. So it could be called up via that in terms of a family court order. And you saw a classic example of that sort of outcome was the Pratt family, where they decided to make capital distributions to the children and leave them unpaid for other reasons. And then when the children went through divorce, the spouses were able to get access to a proportion of those trust assets.
Thanks, Adrian. That's it.
Yep. How to draft effective resolutions. First of all, read the deed. I recognise that you've probably got a lot of deeds that you look after for clients. If they're all coming from one provider, then clearly it's going to be similar. But you should still read the deed. In terms of the resolution, it should identify the beneficiaries, identify the definition of income, should refer to the character of the income. Is it a capital gain? Is it franked dividend? Is it ordinary income? And refer to the power of the trustee to both distribute and then also to characterise it. Referring to the nature of it is crucial. Formula-based approaches are fine. We say no blanket precedents. I think once you've got a pretty good workable precedent, which we'll run through, clearly you've got to apply it to each deed, but you've got a good base there at least in terms of those sorts of precedents. So as Paul mentioned, you will be receiving this separately. So this is the sort of things that we would work through. First off, as I mentioned, determining who is a beneficiary. And in that, we're making sure we're referring to the type of beneficiary they are and how they are a beneficiary. Determining how we're determining income. So in this, we're saying it's pursuant to clause 3.1, the distributable income shall be the income of the trust fund, which is a matter of law, trust law entitled to distribute to beneficiaries. So we're saying our income is the distributable income. Then we have our distribution. So again, we refer to the clause that allow us to distribute, and then we apply it or we pay it. In terms of capital, again, referring to the section that allows us to distribute capital, who it allows us to distribute it to. If we have capital gains and franked dividends, we should have a section that says, points out the clause that allows us to separately characterise it and then record them separately. And creating separate accounts in relation to those amounts. It would be best practice if we had that. And then we actually have our distribution of our capital gain. So in this circumstance, we're saying we're distributing the amount of the income to Sally and Peter after the capital gain. So that's our income after the 50% discount gain, and then an amount of capital equal to that. So we're making them specifically entitled to the entire capital gain and the entire net financial benefit. And then similarly have a separate distribution of our franked dividend, recognising the streaming provisions. We want to make sure our dividend goes to Bucket Co and our capital gain goes to the individuals. After that, we have our distribution of all of our other income. So in this one, we've got the sort of a balance clause, as you say. So the first amount to Peter, to Sally, the balance to Bucket Co. And then, as we discussed before in terms of Lusky's case, have a bit of a catch-all there, or an attempt of a catch-all to say that an amount will go to Bucket Co if there is a change of the distributable income. That's the end of the presentation.
Thanks, Adrian. I will give you, I guess, a little bit more feedback on the other two polls we had. So poll 3, when do you prepare your client's resolutions? Before 30 June was 64%. During a tax planning meeting before the end of the year, 18%. On the same day every year, 2%. And then when I do the tax work after the end of the income year, 13%. So in terms of the final question, have you ever thought about these issues? Yes, 22%. No, 78%. So yeah, not terribly surprised about that last poll.
Yeah, it's not a catch your question. It's more, you know, it's good that you've now got that awareness of these sorts of issues, and clearly there was a lot going on in this family, and it was a large asset pool. But families are funny things, and when they fight, it often turns nasty like this.
Yeah, and I'll probably just add one more comment to the timing of resolutions. It was said to me probably 3 or 4 years ago now that the ATO were auditing one of the mid-tier accounting firms, a big practice, auditing their Melbourne office in relation to the metadata on when actual trustee resolution documents were created. So they will go to, I guess, a fairly significant extent, if they want to determine whether or not a resolution was actually created before or after 30 June. It doesn't look like there's any more questions. So I might pull it up there. Thank you to everyone for coming along. We do really appreciate. We will send an email to get your feedback on today's session and any other topics you'd like to hear from us. These topics that we've been giving are based on your feedback. So we would really appreciate you continuing to do that. If you want to start jotting down some of those questions to ask the experts in a couple of, or in a month's time, please start jotting them down and send them through when we get there. Other than that, Adrian, I do see one question come through, so we might take that and then cut it off. Would you like to comment briefly on the interaction between trusts and family law? That's probably a difficult one. And
briefly. So actually we'll, in part of the testamentary trust presentation that we're doing in 2 weeks' time, we will be talking about this a fair bit and looking at some cases where family law or family, breakdown in family law has led to an attack on a testamentary trust and whether it still works. I guess, we do get this a lot from clients. If the reality is that the asset is something that they've built up during the relationship, or the spouse has had some involvement with, that shielding it in a trust isn't going to do anything. That's very clear. In terms of trusts, you're looking at protecting assets from second relationships or third or fourth relationships, or intergenerational protection via testamentary trusts. But you still need to look, if you're concerned about family law, you need to look at the structure, and you need to look at who controls the trust. And I don't just mean control as in who's named as the director or the appointer, but we need to have people in there who are not just the spouse, so to speak, who could become under attack, and who are not just a rubber stamp for them. So trusts can still be very effective from protecting in family law disputes, protecting assets in family law disputes, and we have acted for clients where that has occurred. However, it does come back to the facts, and it comes back to what the assets were. So certainly, reasonably common. I have someone not come to my office anymore, but query, we've got these assets, having sort of a family law issue with my wife, husband, girlfriend, boyfriend. What can you do to protect them? And usually the short answer is nothing. But in other circumstances, trust can certainly protect against family law claims.
Thanks, Adrian, and thanks, everyone. There are a couple of extra questions there. If I thought we might take them offline in the chat section, but I appreciate everyone coming along, and there will be obviously, feedback survey coming out shortly. So thank you.
Thanks everybody.